You've been told the dollar became king because America was rich, stable, and free. Nice story. But what if that's only the cover? What if the real reason the United States dollar became a superpower isn't gold, isn't democracy, isn't even just military might, but a hidden machine that lives mostly outside the United States, creates invisible dollars, and makes the world breathe American oxygen or suffocate? What if the price jumps at the grocery store, the 19% APR on your credit card, and the rent that never drops aren't just inflation, but side effects of a dollar power grid nobody voted on? Where are you watching from? Drop your city in the comments. And if you want the unfiltered truth, hit subscribe, because this version isn't in your economics textbook. Let's connect the dots. 1913, the Federal Reserve is born. Important, but it's not what makes the dollar a superpower. 1944, Bretton Woods. The world pegs their currencies to the US dollar. The dollar pegs to gold at $35 an ounce. Order returns. America leads. Sound familiar? Then a crack. In the 1950s-60s, something new appears in London: Euro dollars. These are US dollars held and lent outside the US, offshore, outside direct Fed control. Soviet and Middle Eastern money parks there. European banks love it. Offshore dollars multiply, lending explodes, and none of it looks like money printing to the public. Greed finds the loophole. The oxygen line gets longer, more fragile, and less accountable. Sound familiar? 1968-1971. Big players rush to exchange dollars for gold. U.S. gold drains. August 15th, 1971. Nixon ends dollar-to-gold convertibility. The anchor is gone. Now the dollar floats. The system runs on trust. Sound familiar? Trust alone won't cut it. Enter 1973-74. Oil shocks. OPEC flexes. Prices quadruple. In 1974, Washington and Riyadh align, price oil in dollars, and recycle the extra petrodollars into U.S. markets, treasuries, and Wall Street. In return, security guarantees. The petrodollar is born. If you want oil, you need dollars. If you sell oil, your surplus dollars flow back into U.S. assets. That's not just a trade deal. That's a choke point. Modern echo. In 2022, the U.S. and allies froze roughly $300 billion of Russian central bank reserves. That's real power. It's also a warning to every country. This system is not neutral. 1980s. The Volcker shock pushes interest rates near 20% to crush inflation. The dollar tightens. Latin America breaks. The 1982 debt crisis erupts because dollar debt suddenly cost far more. The IMF arrives with reforms. The lesson to the world? Borrow in dollars at your own risk. The lesson to Washington? The dollar is leverage. 1990s-2000s. Derivatives spread. Offshore balance sheets balloon. By 2008, global finance is a dollar drinking machine. When mortgage securities collapse, banks scramble for dollars. The rescue doesn't start in Congress. It starts with central bank swap lines. The Federal Reserve pipes dollars to a tight circle of allied central banks who on-lend to their banks at home. In December 2008, usage peaks near $583 billion. In March-April 2020's pandemic shock, it nears $449 billion. Dollars cross borders overnight. Some systems breathe, others gasp. Sound familiar? Meanwhile, a deeper machine grows under the floorboards. Off-balance sheet dollar debt created through foreign exchange swaps and forwards. In 2022, the BIS tallied it at around $65 trillion. It's not listed as debt, but it acts like it, because those contracts require future dollar payments and must be rolled every 180 days. When panic hits, everyone rolls at once. The scramble begins. The oxygen thins. The private phone tree lights up. Zoom out. Today, roughly 88% of foreign exchange trades involve the dollar. About half of global trade is invoiced in dollars. Around 58% of global FX reserves sit in dollars. Over 60% of international debt securities are in dollars. When the dollar moves, the world is dragged along. And when it breaks, the same small circle decides who gets the mask. Here is the twist the official story skips. The dollar didn't just win. A shadow architecture made it unavoidable. The trifecta is simple. Anchor demand, price oil in dollars since 1974. Multiply supply, create dollars offshore in the euro-dollar market since the 1950s-60s. Control emergencies, flip on central bank swap lines so insiders don't drown, 2008-2020. The permanent consequence? The world is trapped in a cycle of dollar dependence and dollar crises. In good times, offshore borrowing booms. In bad times, everyone scrambles for the same dollars. Moral hazard grows, parasitic finance thrives. The bill shows up at your kitchen table as inflation, asset bubbles, and austerity for the many. Stay with me. Next, we lift the floorboards and show how the wiring actually works. The receipt is wilder than you think. How do these three gears, petrodollar demand, eurodollar supply, and swap line control, actually keep the dollar on top? Let's make it simple and human, with clean examples. First gear, demand, the petrodollar lock. Since 1974, oil, over 100 million barrels a day, has been priced in dollars. If you import energy, you need dollars. If you export energy, you earn dollars and recycle the surplus into US Treasuries and Wall Street. That's why around 58% of global reserves are in dollars, and about half of global trade is invoiced in dollars, even when the US isn't in the deal. Energy priced in dollars pulls everything else into its orbit. Second gear, supply. The eurodollar multiplier. Eurodollars are dollars created and held outside the US banking system. Banks in London, Zurich, Singapore, and Tokyo accept dollar deposits and make dollar loans without US constraints. Offshore leverage, offshore opacity. It looks efficient, it's fragile. The funding must be rolled every few months. The numbers are jaw-dropping. Daily FX turnover is roughly $7.5 trillion, BIS 2022. Much of it in swaps and forwards, the very instruments that create those hidden dollar IOUs. The BIS flagged about $65 trillion of off-balance sheet dollar obligations embedded in those contracts. Most mature in 180 days. That's a treadmill that never stops. More than 60% of international debt securities are in dollars. When conditions tighten, the dollar eats first. Third gear, emergency control, central bank swap lines. When stress hits, borrowing dollars via FX swaps gets expensive. A hidden extra fee appears. Institutions face margin calls. That's when the Federal Reserve opens the dollar pipeline to select central banks, the ECB, Bank of Japan, Bank of England, Bank of Canada, Swiss National Bank, who then auction those dollars to local banks. In December 2008, usage peaked near $583 billion. In March-April 2020, near $449 billion. In September 2019, when the US repo market seized and overnight rates briefly spiked around 10%, the Fed injected over $100 billion per day at peak. The message is clear. If you're inside the network, the oxygen mask drops fast. Now turn mechanics into real life. Energy choke point. Imagine India. It must buy oil in dollars. If the dollar surges or dollar funding tightens, fuel costs jump. That flows into food, transport, and electricity. Politicians blame global conditions. The invisible gear is the petrodollar lock. When dollars are scarce, people far from Wall Street pay with real life. Corporate trap. A Brazilian manufacturer borrows $2 billion in dollars because the rate looks cheaper. To avoid currency risk, it uses 90-day FX swaps. Calm markets, easy, panic. The cost to roll the hedge jumps. The company must find more dollars, sell assets, or cut jobs. Greed for cheap dollars becomes wage cuts in São Paulo. Parasitic finance wins on the way up. The public eats the loss on the way down. The Safe Bank, a European bank, holds $50 billion in US treasuries. Safe, right? It hedges currency risk with FX swaps. When that hidden extra fee, the cross-currency basis, dives, the hedge gets expensive. The trade breaks. The bank must unwind at a loss or borrow dollars fast. The ECB taps the Fed swap line. Dollars arrive. Loss contained. But a bank in a country without a line, no mask, forced selling, fire sale, contagion, sovereign squeeze, an emerging market government borrows in dollars to attract investors. When the dollar strengthens or US rates rise, debt service balloons, taxes are in local currency, payments are in dollars. The choice becomes austerity or default. Meanwhile, reserves get burned defending the currency. The dollar's moral hazard in rich markets turns into real austerity in poorer ones. Let's clear the illusions. Plain English. The dollar is strong because of confidence. Reality. The dollar is mandatory because oil is priced in dollars, and offshore markets create dollar debt everywhere. Debt is what you see on balance sheets. Reality. The most dangerous dollar debts hide in derivatives, footnotes, and must be rolled every quarter. Markets punish risk. Reality. When oxygen runs low, central banks choose who gets the mask. Sanctions are precise. Reality. Freezing roughly $300 billion of reserves in 2022 proved the dollar is power first, money second. Some will look for exits. Most can't find any because energy and finance run on dollars. Rewind with this lens. 1944 sets the stage. The 1960s euro-dollar market multiplies dollar supply beyond Washington's reach. 1971 removes gold. 1974 adds a new anchor. Price oil in dollars. Recycle the surplus into U.S. assets. 1979-82 defends the dollar with sky-high rates, triggering the Latin American debt crisis. 1998, LTCM shows backroom coordination. 2008 turns swap lines from whispers into policy. 2019-2020 proves the rule. When stress hits, dollars move to the club first, markets roar back, and inflation arrives later. You pay. Ask the only question that matters. Is that confidence or captivity? Here's the sting. Because the dollar is the world's oxygen, the US can run bigger deficits and still be funded. Foreign savings recycle into treasuries. When crises hit, the dollar often rises, pulling capital into US assets. It's a self-reinforcing loop. Until it isn't. Each rescue builds more leverage. Each intervention teaches markets to expect another. Rescue breeds risk. Risk breeds bigger rescue. That's not stability. That's a treadmill. So what now? The system is faster. With roughly $65 trillion of hidden dollar IOUs rolling every few months, the next shock won't wait for a press conference. It'll trigger a scramble in hours. Swap lines will open. Some will be saved, others won't. Then you'll feel it again in prices and layoffs in safe markets. Read the tells even if you're not a pro. If borrowing dollars via swaps suddenly gets pricier, that hidden extra fee, funding stress is back. If the Fed's swap line usage jumps, the club is gasping. If repo rates spike without warning, the pipes are clogged. If the dollar index surges during a shock, the scramble for dollars is on. The takeaway is simple. Denial is expensive. The dollar AS superpower isn't just a flag. It has an architecture, oil priced in dollars, offshore dollar creation, and crisis pipes that bypass democracy. Trusting institutions built on borrowed time means living with permanent instability and periodic surprises that never surprise the insiders. If this helped you see the wiring behind the walls, share it with someone who thinks the dollar won by confidence alone. Tell me where you're watching from and what you felt in 2008 or 2020 that you never want to relive. And subscribe for more unfiltered truth, because the official story won to warn you before the oxygen runs out. Are we wiser now or walking the same path in better suits?